Hello, everyone. Today on the final bar, we'll talk about the S&P 500 finishing the week more in a position of weakness rather than strength. Most of the selling coming through the lunchtime hour, a bit of a recovery into the close, but overall, certainly the average stock finishing weaker rather than strong. With technology dragging the most, but Utes and real estate end up winning on the downside. It's all about a question of, is this further distribution or just a reshuffling of the chairs? Ladies and gentlemen, this is the final bar. Good afternoon and welcome to the Final Bar. This is your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the action of the markets, and especially on a Friday. Take a step back now that the flickering ticks have ended for a couple days. We can take a look and see Friday to Friday, how has the story changed? How have the markets evolved? What do we need to know as we think about the market environment going into to next week? You know, it's been all this week. I feel is the number one question I've asked all my guests, I've asked myself, and I've posed to you is, how do we differentiate between a garden variety buyable pullback within a longer term uptrend and recognizing internal weakness as the beginning of something stronger and with more downside potential than what we've seen thus far? And I think the answers we've gotten have been pretty meaningful. It's all about how certain stocks hold up, if stocks break down through key levels, or if they're able to remain above them. The breadth measures we've talked about, do they remain strong enough to suggest, just we're in pullback mode versus downside mode? And to be honest, it's the leadership names. It's seeing whether the strength in healthcare, financials, other sectors are enough to repel the downside, dragging us down with technology. Now, we have a lot of fantastic guests on the show. This week was a lot of fun talking with some pretty sharp traders and strategists, guys like David Auerbach, David Settle, and so forth. Patrick as well on Wednesday. I did want to point out, next week we have Tim Brackett joining us from Markets Compass for the first time. That's on Tuesday. On Wednesday, the 23rd, Leslie Juflas from Trading Live Online. And then on Thursday, the 24th, Todd Sohn from Strategas coming back to us from New York. On Tuesday, the 22nd, we're putting the finishing touches on our special event introducing StockCharts ACP. This is going to be a mix of live discussion as we unveil this new charting platform to all of you. Again, it sits on top and within all of the StockCharts tools. Those are all going to continue to be a part of your process on our platform, but this ACP platform is sort of the next level that is an additional set of features that you'll have access to. And we're going to have people like John Murphy, Martin Pring, Larry Williams, Ralph Acampora, Arthur Hill, Mish Schneider, Dave Landry. I think I got them all, along with Chip Grayson and I from the StockCharts team, having a lot of really cool conversations about the evolution of technical analysis and how the dynamic environment that ACP provides is really ideal for understanding a market that is in a period of increased volatility and uncertainty. So join us on the 22nd for introducing StockCharts ACP. Our next segment, we wrap the week. As we've talked, every Friday we do a segment called Wrap the Week. It's really focusing on the evolution of the markets over the last 7 trading days. I want to start with a poll, though. We always have a poll going on our StockCharts TV page. I encourage you to engage with that anytime you can. It's a great way to just have a conversation about the markets, give us some things to think about. What I asked all of you was, where does Tesla close on December 30th, 2020 with perfect foresight? What do you see? And just as a reminder, the time we asked it, Tesla around 442 here is where it closed around there on today on Friday. So we gave you above 750, between 500 and 750, between 250 and 500, or below 250. The majority wins so far. The majority answer, at least, we'll see who wins at the end of the year, but the majority answer is between 500 and 750. So that would be basically suggesting Tesla between now and year end breaks to new all-time highs and remains up in this range, or blows way past it and at least comes back. But and sort of above the current previous high. A quarter of you said we're in the range now. It sort of chops around, backs and fills right around here. Only 5% said Tesla's going down significantly further than that. And 12% of you actually, over 1 in 10, said above 750, which is a pretty, that's another 50, 60% rise in the stock. So, it's interesting. That's the kind of question I think it's interesting to think about, how you would be prepared for different scenarios if you own a stock like Tesla. If you're holding off, what would you want to see given those different scenarios? It's interesting. I think the real question is, if the market corrects meaningfully from here, what are the chances that a stock like Tesla could remain elevated and sort of remain in that 500 to 750 range if the S&P goes down another 10, 15, 20%? Again, not saying that's definitely going to happen, but it's an interesting exercise. And while I don't think technical analysis is about predicting the future 3.5 months out, and certainly don't ever think that that's what I'm suggesting. I think it helps to think about potential future paths and how your toolkit would deal with that, and what you might be looking for to confirm one of those scenarios might actually be playing out. So as we wrap the week, let's just look very quickly at where we finished the day here. As I mentioned, the S&P closing just below 3320. That's down just over 1% from Thursday's close. So Thursday and Friday, sort of a similar scheme where you had some selling, a little bit of a rally going into the close, but overall, certainly just the stepwise motion lower. We're going to look at some markets and stocks and those key 50-day moving averages. Mid caps and small caps down as well. Small caps actually outperformed. They were only down about 0.6% today, and the Nasdaq led on the way down 1.3%. Again, this is one of those days where stocks and the VIX, stocks and volatility, were all sort of down today, with the VIX around 26. Bonds closed weaker as well. They really spent most of the day just chipping their way lower, only about 1/3%, so not horrible, and 10-year yields creeping back up to around 70 basis points, just below that right now. Oil sort of chopped around and finished flat, but at times was a little higher. Gold also finished flat as well after opening pretty strong. So there are a lot of sort of movements in the second half of the day that sort of reshuffled things, but certainly continuing, I think, the themes that we've seen up until today. Very quickly, I want to hit on some sector themes, and we'll look at some stocks, and then we'll focus on the Mindful Investor Live chart list. It's worth noting the number 1 and 2 sectors today, healthcare and financials. Healthcare almost finished in the positive, finished just a little below zero, but holding up very, very well. We're going to look at Merck a little later, and you think about stocks like Merck and what they're doing versus stocks like Microsoft and technology rolling down almost 2% again today. Kind of interesting. The other thing, and again, I always caution people, don't think about a market direction. The market's going to go down, which means things like utilities and real estate, big, high dividend payers should probably do very well. Again, none of these things are happening in a volume. So while in general, that is the long-term relationship, Utes and real estate, actually the two worst sectors to get, actually beating technology on the way down. That changed a little bit going to the end. I think tech was sort of at the bottom of the list, but sort of being taken over by some of those more defensive sectors. Materials also fourth from the bottom, and we've talked about the XLB being one of the better longer-term charts, really breaking. It's consistently pounding way to new highs, making another 52-week closing high this week, but today sort of finished more lower. So sort of a mixed bag in terms of where sectors were. It wasn't a pure offense, one side, and defense, the others. It's really mixed, and I think it really confirms to me we're in a transition, and transitions are not clean, and they're not a day, it's not a moment, it's a process. This is one day among many. So let's look at some of the longer term trends and think about what they represent. I did want to spend just a few moments here talking about some of the key markets and the 50-day moving averages. One of the themes we're going to talk about is how a lot of these are starting to break down, especially from some of those FANG names, the leadership names. This is the XLK. As we talked about recently, the question is the XLK able to hold its previous support levels and able to hold the 50-day moving average? Today certainly feels like follow through to the downside. We've now closed below the 50-day moving average and want to see the beginning of next week if it continues lower. But all else being equal, this certainly speaks to the potential and the probability of further downside for technology before all this is said and done. I think that's a safe assumption from here. The RSI is holding just around 40. And again, if it breaks down through 40 going into next week, that would tell you a little bit about about the the strength of the downside momentum and the potential there. The relative strength line is just rolling over as well. And again, the trend overall has still remained fairly positive, but we're potentially putting in a lower peak and starting to break down below some previous support on the relative line as well. So really speaking to how things are rotating away. Looking at some of the individual names in here, we see Microsoft again now breaking down through its 50-day retesting and going down to the downside. Just going quickly, these aren't all in technology, obviously, but just the sort of the FANG trade. We have Amazon that broke down through the 50-day actually last week, and now we've arguably completely validated that breakdown. The last thing is the 2,900 level. That's the low from July. So now we're seeing the run up in July, this pullback, and that's where we're sort of testing support. Again, based on what I'm seeing, I think we'll see weakness rather than strength with the stock like Amazon here. Elsewhere in the FANG universe, we have Facebook breaking down. I guess have to go through all of these, but this is the general theme I think you're seeing here. This is the leadership that got us here. It's all rolling over. These are big mega cap stocks. So even while some stocks may be holding up okay, even on today, pretty much everything was down, but even on days where there's weakness in stocks in the S&P, it's the big mega cap names that a lot of times could be dragging things down. It's not necessarily a broad thing. So make sure you're looking at a lot of different places to confirm what we're seeing. Our weekly trend model, which we update at least once a week here, short-term turned bearish last week, and this is when we just started to sell off and traded below the 5-week exponential moving averages. Average. The medium-term indicator is the weekly PPO or the weekly MACD using the traditional settings. Not enough weakness to trigger that yet, but I'm not surprised because that usually would need a little bit more of a downside push. Last sell signal you got was back here in mid to late February. The long-term trend certainly still bullish, and I think that's fair based on where we've come from. You have to see a lot of pullback to register any sort of negativity from the long-term trend. So at this point, based on where we closed today, short-term bearish, medium-term still bullish, long-term still bullish as well. The daily chart of the S&P is certainly concerning here, and the question going into the end of this week was, are we able to hold above the ascending 50-day moving average, which again, a lot of traders, a lot of investors, a lot of systems use something like the 10-week moving average or the 50-day moving average as just a guidepost. If we're up, just very simply, if the stock's above its 50-day moving average, it's in an uptrend. If it's below, it's in a downtrend. Even that one simple thing can help you differentiate from uptrends to down. Make sure you're on the right side of things. Worth noting, the S&P now breaking down through its 50-day moving average for the first time since back here, since in April. And the last time it was above and then broke down here was at the February peak. So again, this does not look exactly like the February peak. Don't get me wrong. It's certainly not what I'm suggesting, but I am pointing out that we're breaking down through support, which certainly is characteristic of a bull market top. As we've talked about, I think the base case for me is we go down to this blue shaded area around 3,200. I think safe to say that's where I'll be looking, and also looking to see if the RSI remains around its current levels. The breadth picture has been negative for a while, so I don't mean to beat this any further, but just pointing out that we've had this bearish divergence with weakening breadth going into the peak here. The S&P breadth is still sort of holding neutrals, hasn't broken down while the other ones have. But again, across the cap tiers are certainly seeing some internal weakness. The little green bars here over the course of the last week, and this isn't updated for today just yet, but it's worth noting there have been stocks making new 52-week highs. I even ran a screen yesterday and had a good group of names. It wasn't a handful. It was a couple handfuls of stocks that were making new 52-week highs yesterday. So they're out there. I think it's a really good time to have a stock picker's mentality. And even if you see some weakness around, there are stocks that are going to set up pretty well. And it's just a question of finding them and where they're at and determining the risk reward scenarios. Another look at breadth is the percent of stock above their 50-day moving average. And I think this is a key one to note. It's interesting to see how we've had sort of another bearish divergence here as the market's gone above 3,400 into a peak just below 3,600. Less stocks recovered their 50-day moving average on the way back up. And we're down to around 60%. With any of these things, the 50% line is just a base measure that I look at, and I usually look at with a percent above their 200-day, which if you think about it, that's another 200 points on the S&P. That's a pretty long way down, to be honest with you. And so we'd have to move pretty heavily to the downside for this to go below 50. But that, for me, would be okay, things can get a lot more painful from here. You'd have to break down through that first, and we're nowhere near it. So it's certainly not the end of the world just yet. We hit on sentiment yesterday, so if you missed that, go back to our replay on our YouTube channel. You can see some of the comments on the AAII survey and the name active investment managers positioning. In terms of ratios, the ratio of cap-weighted consumer discretionary versus staples sort of rolling over, but the equal-weighted breaking up. And what that tells you is Amazon is looking weaker relative to the rest of the space, and that's what's dragging the cap-weighted ratio a little further down. On an equal-weighted basis, essentially that's telling you there are better stock-picking opportunities within consumer discretionary versus consumer staples, all else being equal. The semiconductors, we actually have a question in our mailbag about that, so I'm going to come back to that one. I did want to point out small caps have outperformed in the months of September, but again, I'm eyeing this, long-term for the last 3 months. It's essentially been flat. I did also want to point out growth starting to break down versus value. There are a couple ways to look at this. The last time we broke below the 50-day moving average was back here in June. This is around the June peak, and from there we went right back to growth. So I think that's the question, and as we start to differentiate now versus sort of that June-July period, are we able to, do we see a similar thing where growth once again takes over? That tells you that the correction is shallow and leadership is reemerging right where it left off. If we see this ratio continue to go down, that tells you the growthy stuff that's gotten us here is starting to weaken, and it might be a good opportunity to look at more value-oriented places like financials and other sectors you might have been ignoring for quite a while. Last chart I just wanted to get to is just to remind you, U.S. has been underperforming global stocks, and if you're not looking at sort of non-U.S. names, again, when this ratio turns down, it just tells me if you've been writing off your international exposure, you're giving, you're basically in a performance hole. You have the opportunity to outperform your U.S. holdings if you just think about where you might want to allocate outside the U.S. That is our wrap the week. And again, the general theme is stocks. We've talked about the ascending 50-day moving average, the S&P 500, and many of the larger names violating that today. And for me, that validates this short-term weaker thesis. I'd have to see a lot of improvement before I start to feel a little more optimistic about a resumption of the long-term uptrend. I think that's where we're at right now. Let's take a quick commercial break. Back with the final bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. As a reminder, we love hearing from you. Feedback on the show, on the channel, on the hosts even. We'd love to hear it. But most importantly, we'd love to hear your questions. And again, what we hope to do with StockCharts TV and with the final bar is to encourage you to dig deeper on your own, to give you things to put ideas in your head, just little nuggets of things that you could dig into more when you spend some time going through the charts. Any questions that come up along the way, shoot them to us via email, thefinalbar@stockcharts.com. Also on Twitter @finalbarsctv, or on our YouTube channel. Any videos there, just put a comment right below the video. We'll gather all of those and answer hopefully some of your questions in our next mailbag segment. Let's open the final bar mailbag now. We've had a great number of questions recently. Really appreciate all of you sending some great charts. Charts are always helpful when you're asking questions because I can see what you're looking at. And let's get to it. Let's see, I've been successful in identifying support and resistance lines on this chart. I think it's this one we were looking at. Yep. Let's see, and I'm getting confused while buying because buying right at the support zone reduces my risk on trade substantially, so I can buy more with less risk, but price doesn't get bounced every time after touching support. If I wait until the uptrend resumes, price will be moved from the support zone. It will increase my risk, eventually downsizing my investment on that trade. Really good question, and what I'll summarize, and this is a name, an Indian name I'm not familiar with, so I'm looking at this with fresh eyes here. But essentially what you're identifying is coming out of these lows here in April, this uptrend channel, which is a parallel channel essentially of higher highs and higher lows. And there are a couple ways to do something like this. I encourage you also to look at a regression channel, which is basically you start the clock at a certain point, usually after a major turn, and then it actually is a best fit line, and then you can do a couple standard deviations above and below that that least squares regression, which is basically a best fit line to the trend of the stock. So you drew some beautiful parallel lines. I'm saying you can actually use the data and identify the regression around that midpoint as well. It gives you a similar sort of idea. And your point was, ideally, you want to be buying weak, buying down at the lower end of the channel, selling at the upper end of the channel. It's actually a pretty decent, swinging approach, sort of betting on the volatility. So your question was this: if I buy down here, your attractive risk reward, because you're basically assuming upside to there, and the only downside you have is minimal, but you have the potential to get missed, right? It actually breaks down through support and you miss it. But if you wait for some sort of upside validation, all of a sudden you're giving up the beginning of it. You have basically summarized, I think, the challenges and the benefits, the upside and the downside of using a leading approach versus a lagging approach. And here's what I mean. Using this sort of chart as a leading indicator means once I determine this channel, keep the lines going, and I'm going to buy every time it's at the lower end by some methodology, and I'll sell when it gets more closer to the upper end. And in general, that's going to work great until it doesn't. And so what you do is you buy aggressively and you have some sort of stop. And whether it's, a lot of times it would be simple things like, I'm going to, if we break the low of that lower end of the channel, if we break the low of that price bar, then I get out. Using average true range, if we have X%, X times the ATR, meaning here's how much the stock usually tends to trade, I'll give another, 1.5 times that. And if we break that, then that's my stop. So you get in buying when the price is weakening, but you have a stop. So if you're wrong, you minimize the pain of that. If you're right, you've gotten in at almost the ideal level. If you wait, you're using more of a lagging indicator. And again, there's no wrong answer. It's more about where you want to be comfortable with. I would tell you with this sort of channel, and if this is what you see continuing, then buying at the weaker side and selling at the higher side certainly is a valid way to think about that. And I would just think it's less about, you certainly don't want to be wrong. You're going to be wrong at some point by definition because the price is going to go down and break this channel. So you just want to make sure that every time you enter, you have some sort of stop on the bottom side of that. Next question, FedEx, to my belief, went up 20 points after hours. This is from a couple of days ago, so sorry for not looking at it until now. Will the transports allow a correction below the 50-day moving average? I agree Apple may correct below the 50-day in a couple of weeks. I have a question in your house. Oh, great. Okay, so I'm sorry, I'm summarizing here, but you basically say, I always talk about the 50 and 200-day moving averages. You use the 21-day moving average. What about that? And how should I think about those? So yeah, listen, I think there's two general ways to think about moving averages. And I'll tell you the one, option one is look at what you think other investors are looking at. Use this as a way to get inside their head and take advantage of the fact that a lot of people are betting on the price relative to those moving averages. That's what I tend to subscribe to, which is why I have the 50 and 200-day moving averages. Having worked with many, many institutional investors, 90 to 95% of them, if they have a moving average on their chart, it's the 50 and the 200-day moving average. So I know that's something they're looking at, and that's why I want it to be something I'm looking at. Having said that, the 21-day moving average may be a much better feel for your horizon and what you want to do with it. The thing I would say is look back over time, see what trades that would have given you, see if you think that that's a good representation, and if that's what works for you, then that's totally fine. I think, a lot of times, as much as I could answer your question and say, here is the optimal one, I don't know if that's right. I think it's about finding the optimal one that, for you. And I've seen people use lots of different combinations with success. It's more about the consistency of applying it than there is a right answer. I would also point out one last thing. We talked earlier this week about exponential moving averages, and I take a look at those because if you're using a moving average system, that a lot of times will do a little better. Next question, and this is a long one, so I'm going to paraphrase as I read. I've read opposing information about when institutions buy and sell stocks. Let's see, right before 10:30 a.m. or something like that, or is it at the end of the day? I've heard some conflicting answers about when they do it. Yeah, so I mean, listen, I'll give you the general answer. And again, there are a lot of firms doing a lot of different things. In general, you tend to think of the first 30 minutes or so, first hour as sort of, I hate to say the dumb money. That's not a great description of it, but sort of the individual, the not institutional investors. That's tend to where you think of them entering. I know from my time working at and working with large institutions, you would never touch things at that point. I mean, it's too volatile, it's too uncertain, and you want things that are more predictable and more you can plan around, especially if you're investing large amounts, and trying to scale in and out of a trade. You're trying to find optimal levels, and it's hard to do that when things are just whipping around first thing in the morning. The last 30 minutes, the last hour is absolutely when a majority of the trades would be done, because if you're putting in a huge order or a huge set of orders, you want to minimize the impact on the market. And so there are a lot of things you can do to try it. It's all about trying to, disguise what you're doing as much as possible. Nothing inappropriate or illegal or anything like that, but it's more about trying to make it anonymous and reduce the impact, because you're not helping your shareholders if you go and you get them a worse fill because you're broadcasting what you're doing and other people can get in front of that. So there are things like dark pools and everything that institutions can certainly use to try to minimize the impact of what they're doing. But I would also say, the end of the day is usually it. So if you look, there's usually a barbell on the chart. If you look at the daily volume, there'll be a bunch in the first hour and a bunch in the last hour. The first hour is usually sort of retail trading. The end of the day is usually institutional. That's a pretty safe bet even now. Also, ETFs will do rebalancing and stuff at the end of the day, so you'll see that impact as well. Next question, can you remind me what this flag formation represents? And then, boy, we're out of time. It's so brutal. Here we go. We were looking at this one, which was the performance of semiconductors versus the S&P. And you said, is this a flag formation, and what does that mean? So here's the thing as I'm getting to the chart. Is it a flag formation? I guess you could say that, which is a long upside run with two parallel downside moves, right? So a lower highs and lower lows moving against it. I am not a huge fan of using price patterns on relative strength lines, though. For me, the relative line stands on its own. I don't use 50-day moving averages or anything like that a lot either. For me, it's more just about the highs and the lows and if the trend is positive or negative. So while, yes, I think you could classify it as this, if you wanted to use it as a flag, you set a trend line using the peaks. If we break above that, that would validate it. But price patterns, if you look back at Edwards and McGee, which is really the Bible of technical analysis, these guys talked about price patterns as being a reflection of investor psychology. There's a whole volume methodology they would use along with those patterns. And I think a lot closer to that. I'm okay with patterns in price. Patterns in relative strength, I think I have found are less meaningful. I've seen people that argue otherwise, but you asked me, and that's my answer. Everyone, thank you so much. We didn't get to a couple of those. I'll make sure we get to them at the beginning of next week. We need to wrap the show, though, and wrap this week. So let's go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is growth versus value. And I'm using 2 ETFs here, the IWF and IWD. There are a couple different ways you can do that, but that's a pretty easy way to do so. This is super early on. So again, I'm not proclaiming the end of the growth trade and the beginning of the value trade, but I am always looking when a ratio like this turns, because that's how it would start, right? You'd have to go a lot further down, breaking to new swing lows, making a new, a lower high, rotating this ratio back downwards to make it look anything other than what we saw back here in May and June. In May and June, you saw a very similar pattern, and then it rotated back to the upside. So at this point, I'm going to assume that the uptrend continues until proven otherwise. But again, this could be the beginning of it. That's why it's an important chart to watch, I think, going into next week. Chart number 2 is looking at stocks versus bonds. And we do this using the SPY versus the TLT, which is the long bond ETF. This ratio rallied pretty good out of the March lows as stocks accelerated to the upside, really sideways through the months of June into July, and then rallied pretty well into the end of August. From there, it's been leaning back towards bonds, away from stocks and into bonds. Both of those assets have been struggling, but stocks have certainly sold off a little more, and that's why it's coming off. I'd be interested to see if that ratio continues lower, because I think a lot of people have essentially been either literally or mentally all in on stocks here. Finally, an interesting ratio just to show you there are stocks on the move. This is the price of Merck testing new swing highs. This is the chart of Microsoft breaking to new swing lows. This is the ratio, which now for the first time in the last 3 months, making a new 3-month relative high, favoring Merck over Microsoft. That sort of pattern is something I think you're going to see a little bit more of. And I would certainly encourage you to look at places like healthcare and elsewhere that you've been ignoring, financials even, see what emerges. Folks, that's our week. Thank you so much for watching us all week on the Final Bar on StockCharts TV. As a reminder, all of our previous episodes stored on our YouTube channel. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.